We're here for PLP, okay? Peace, love, and prosperity. Welcome back, everybody, to the $100,000 to $1 million public account series. Okay, we had a pretty nice day today. We're up $4,300. That puts us at 129.6, and we actually did encroach up into the 130 area this week. We are at 131.6, but until I sit down and record a video and we're north of 130, we're not going to consider that a milestone. Also, I was thinking, so if we can get to 5,000 subscribers, I think we're at 17 or 1,800 now. If we can get to 5,000 subscribers, what we're going to do, every $10,000 milestone, I'm going to take $250 cash. We're going to find a random homeless person, and we're just going to give it to them and say, have a day, no strings attached, all right? Just don't die, all right? We're here for PLP, okay? Peace, love, and prosperity. I don't care what you do with this. And we got the meta glasses too, so it's perfect, all right? Anyway, so this week, we made a couple different trades. We traded down a little bit of SoFi. We traded down a little bit of Microsoft. We purchased a little bit of Google, and we purchased a little bit of Meta. We had a little bit of a rough day yesterday. We were able to hop on that and buy up a little more. We have a $45,000 cash position right now, so we're sitting pretty comfortable. And if there is more pullbacks, we'll happily buy some more stock. So also, if you watched the last video, I talked about Celsius and Iron. We went in and bought some Celsius and Iron. In the last week, those stocks are up over 20%. We sold out of them. We made our profits and we're off into the sunset. So if you were inspired by the last video and went and bought some Celsius or Iron, congratulations. I'm glad you could hop onto that. I'm glad we could put you on. Welcome to the channel. Anyway, so what I want to talk about today, the AI bubble. So essentially, bubble is a euphemism for you're going to lose a lot of money in due time, okay? What people are referring to with the term bubble is the dot-com bubble. The dot-com bubble happened from about 1999 to 2002, where a lot of these internet stocks just fell on their face. So what we do as an intelligent trader, learning from the past, is we say, what sort of companies were absolutely leveled by the dot-com bubble, and what can we look for in a stock today that makes it sort of immune from any sort of bubble pop? And the best way to do that is to analyze what stocks have unrealized AI profits built into the share price. So one thing before I go to the next slide I want to talk about is we have to remember that a share price, so say Microsoft being $500, is that $500 label is completely arbitrary. You know, a company is like a pie, and a share price, you can divide the company into 1,000 shares, 1,000,000 shares, 1,000,000,000 shares. So the share price is completely irrelevant. What is relevant is the value that we're getting for the price point. So a trailing PE. So I'm going to go back into, we're going to pick a random stock here. Let's go to ServiceNow. ServiceNow is a SaaS stock. That means software as a service. So let's go down, we'll check its P. It's at 78. So we're expecting some very aggressive growth rates out of ServiceNow based on their PE ratio and whether they justify that or not. However, when we go into this stock, the first thing that I do when I analyze a new stock is I scroll down and I find where it says price to earnings ratio. And what is that? The price to earnings ratio is the trailing PE, okay? That's the price divided by the earnings, the share price divided by the annual EPS, earnings per share. Forward PE is the share price over guidance. So remember we talked about SoFi. SoFi had a triple beat quarter. They beat on revenue, they beat on EPS, they raised guidance. What is guidance? Guidance is the future projected EPS. So companies are able to set their own benchmark. They'll say we're growing at 15%. Now, this can be a little dangerous because if a company overshoots their guidance and they underdeliver on that earnings report, now you don't have a triple beat. You lost on revenue, you lost on EPS because those are benchmarks that you set. So you have to be very diligent and honest about when you're setting your future guidance. So guidance, as an example, this is Microsoft. So this estimated 470 per share is a benchmark set by Microsoft saying we're growing at 17%. So based on our EPS this quarter, we'll be 1/4 of 17% higher in the next quarter. So if Microsoft comes out and beats this number and raises their guidance, raises the expectation moving forward, that's a great thing. So remember we talked about this. Each sector has its own sort of preferred PE ratio, whereas a healthy range. So tech is honestly the highest one. And right now we're seeing semiconductors pull away from tech stocks and sort of have its own niche sector pricing because you see a lot of crazy PEs coming out of the semiconductors. But if you look at financials, remember SoFi is a financial stock. They're a fintech stock. Banks have the tendency to go bankrupt. So they traded a little bit different of a multiple. Same with energy and so on. So we have to be diligent in analyzing these PEs. So this is a random picture I pulled off Google. I have no idea what these companies are, but they say they're peers. So I'm going to assume that they're in the same sector. So we talk about company number 1, whatever this is, at a 15 PE. We talk about company number 3 is at a 9.3 PE. Company number 8 is at a 23 PE. So I would expect company number 8 to have more anticipated growth for the future than company number 3. Now, if it weren't the case and it didn't have that sort of growth, then I would be looking to short down this company thinking that this is overvalued. Because remember, that would mean the share value is far ahead of its EPS. Whereas company number 3 here, having a very modest 9.3, has a much lower share price relative to its earnings per share. So let's go into this. This is what I'm seeing now. Capital rotation. So, oh, my face is in the way. I gotta make me smaller. Capital rotation. So what you see, like right now, remember we talked about SanDisk and we talked a lot about these companies. You see crowding, you see hype, you see pumps. Then a lot of those early investors begin to pull out liquidity and say, I've made a ton of gains. I'm going to start pulling my money back and I'm going to start cashing in these profits, which is totally normal. Just like what we did with Microsoft. We said, all right, now we're up 35% on Microsoft. We can start drawing our money back. So you see a nice liquidity sweep. And then what do you do with those profits? Exactly what we did. We go and buy other more opportune stocks that are going to make us more money in the short term. So capital will flee one sector. So if we consider semiconductors a sector and tech a totally separate sector, which traditionally it's not, but for this case, we're going to call it. Or you can see the vice versa. You can see money pulled from big tech and into semiconductors. And that's what you saw in 2024 when those Capex numbers came out and everyone said, oh, they're spending so much money on these semiconductors. Let's take our money from here and buy up these semiconductor stocks. So here's a perfect example, SanDisk. The only way you might know SanDisk is if you have a little thumb drive sitting by your computer. SanDisk makes these memory cards and this sort of thing. I really honestly don't even know the full story, but look at this company. It's up 3,190% in the last year. Okay, that's an explosive year. Okay, so what you're seeing right here is a big old pump and then a liquidity grab. These are the original investors. If you invested way back here and now you're up 1,000%, you're saying, okay, I'm going to pull this money out. And then you say, well, what do I do with it? I find an opportune place to put this money. So as we can see this liquidity grab, now think about this though. We're getting close to 2027. So that means these big tech companies are going to have to start coming out with their anticipated Capex for 2027, which could really put the ball back into the court of these semiconductors. So you're seeing this liquidity grab, and this is decision time. You know, Q4 of 2026 is decision time to whether the semis are very bullish going into 27 or if that liquidity flows back into big tech. So let's take a look at Meta for a second. So Meta's trailing PE right now is at 22. So its forward PE based on its guidance is around 19. Meta's historical PE is around 28.2. What story does that tell us? What information does that give us? So that means historically, prior to AI, you are paying more of a premium. There's more anticipated growth built into the share price than there is right now. Now, what that tells me as an investor is that even if AI fell flat on its face and didn't work and they have all this debt and all these sort of things, I'm still getting a cheaper premium than I would have paid historically on Meta. And that's how we capitalize on Microsoft. When Microsoft got hit and their PE fell into that very bearish range, we picked it up, we ran it back up to where it is now, and then sayonara, see you later. We're on to the next bigger and better thing. And what I can tell you is if Meta lowers that Capex or they start to see those realized profits from this AI build out, Meta will easily double. And here's why. Because if they stop spending so much money, that EPS is going to go way up. When the EPS goes way up, the PE ratio goes way down unless the share price goes way up with it. So personally, I would consider Meta, aside from sentiment, immune from this AI bubble that people speak about. Now, let's look at Google. Google's trading at a trailing PE, so current PE of 18 times, a forward PE of 12. Do we notice a trend here? Google's historical PE is 27.7. So you're paying significantly less of a premium than you would have historically to buy a share of Google right now. So that gives me the comfortability to say, even if AI fell flat on its face and it wasn't what everybody believed it to be, I'm still getting Google at a better discount than I would have gotten prior to AI. Now, Capex. Okay, this is what we just talked about. 2027 Capex is going to be absolutely huge for the market in Q1 of 2027 and even into the later. Wait a second, guys. We just hit 130. All right, hey, if we can get to 5,000 subscribers and we hit it on video, then $250 is going to a random homeless person. They're going to have an absolute day. So make sure you subscribe. So anyway, if it comes out that these, they're going to spend almost $1 trillion over 2027 building out AI infrastructure, then the semiconductor and the memory stocks are going to continue to rage on and set new highs, and tech might pull back a little bit. What does that give us the opportunity to do? Load the boat, back the truck up, put the shares in the bag, my boy. Remember, all we're after at the end of the day is cheap stock. We are a consumer of stock. We are trying to buy stock at a very discounted rate. And I want to use this little analogy for a second, okay? Because a lot of people that don't deal with the stock market, the biggest variable cost item that they come across is gasoline. So imagine you have this gasoline tank in your backyard, and gas is at $2.50 a gallon. And you're saying, I want to sell this gas eventually. So I'm going to buy up as much as I can at $2.50. I'm going to load the tank. Say now gas goes down to $1.80. What do you say? Oh, let me sell my gas. No, you say, let me buy more gas, fill the tank, all right? I got more time to take my income, my personal income, and purchase this gas, knowing that in due time, this gas is going to be worth a lot more. Now, let's say gas goes up to $5. You sell off all your gas, you make all your money, you're feeling good, you got a new car, you're doing all this stuff. What are you thinking? I know what you're thinking. It's what I think. Man, I wish gas was cheap again, because I could load up on it. Man, I wish gas was cheaper a little longer so I could have bought more. So even if these semis do take off and the memory stocks take off, we have to remember that we are consuming these tech stocks at a very discounted rate. Now, why do I say that? Why do I not go take my money and put it into the semiconductor stocks and all this sort of thing? And here's exactly why. As a fundamental trader, are the profits here to stay? Probably not. What I can tell you 100% certainly is that the current growth rates are not manageable. Now, if you're Meta, if you're Microsoft, if you're Google, you can certainly continue to grow at 15, 20% annually. That's very manageable. But to grow at 180x is just completely not possible. So I'm not going to take my money and hope and pray over here that I'm not the last person to get off the boat before it nosedives. So anyone who sits here and tries to fearmonger on this AI bubble, I understand it. I understand the fear, especially for the people who traded through the dot-com bubble. I was not alive yet at the time, so I really don't know how that felt. But what I can tell you is that if you're diligent and you pay attention to the premium that you pay per share, that you are essentially immune in the long term to any sort of bubble. So I want to do some call outs here before we go. We may go long on Lululemon. We're not sure yet. We're still doing our due diligence. And also, we still have under a microscope, we have Celsius, Salesforce, ServiceNow. Amazon might be falling back into a buy range. So over the next week or 2 weeks or month, I'm definitely going to be analyzing these stocks and finding out what the next big push is. But we're officially through the $130,000 mark. That's $30,000. This is the 8th episode. Anyone who's been trailing these trades, congratulations. We're doing great. We love to see it. And I'm really hoping that we can get to that 5,000 subscribers because I would love to give away some money. With that being said, thank you very much for watching. Make sure you like and subscribe, and I'll see you in the next episode.